We are very excited to be able to offer the RPAG network our AB Large Cap Growth Solution, which currently scores a 10, under the CIT label, Large Cap Growth 3. And that would be at a total expense ratio of 32 basis points, which is a 40% discount versus our 40-Act fund and a price point that's only available to this group. So we're very excited to keep the momentum going that we've created with you over the years with this new offering. Now, my team at AB will be reaching out to answer any questions you may have and see how we can help you grow your business. But let me now introduce and hand over the call to John Fogarty to give a high-level overview of our strategy, to talk about how the philosophy and process finds profitable growth companies in uncertain markets. John, who has been with AB for over 20 years, is our co-chief investment officer for U.S. growth equities and also one of the lead PMs on our large cap growth strategy. There are a few slides that John will be referring to, but please ask questions. I believe there's a chat box there along the way. We'll be happy to answer anything that's on your minds. John, let me turn over the call for you, and I will drive the slides.
All right, thanks, Lou. In addition to driving the slides, I don't see chat box on this large screen I'm looking at, but I do see the slide deck. So
I'll let you know if we have any questions that come in.
Awesome, thank you, Lou. Lou, if you could turn the page to page 1. So I imagine you've sat through many of these presentations. People probably gloss over philosophy, run on to people, process, performance. This is different. We are very much anchored in our philosophy, and it distinguishes everything we do. Even in this brief overview, hopefully you'll see why. Part of the reason why philosophy can be efficient is that it helps manage bandwidth. And I'll describe that briefly on the next page. But also I want to say it's very important because it centers the portfolio. It helps it be resilient and exhibit consistent factor exposures. I think that's important, particularly as environments change, that we're not trying to fit to a ever-changing complex set of circumstances. And then importantly, you will know how it should behave through the risk-on, risk-off economic cycle. A lot of my competitors basically say, hey, we're growth. We look for great growth rates. That's not us. As this quote says, we're looking for the intersection of profitability and reinvestment opportunity to unlock the power of compounding. So we're looking for highly reliable profit streams. And we think you get that through a combination of defense, in other words, high profit generation, and offense, compelling investment opportunities. That grounds us in what we're looking for, and it provides the consistency that will shine through as we go through the next couple of pages. And just to state the obvious, we have not changed the portfolio, whether it was in the wake of the great financial crisis when demand was the concern. We didn't change the portfolio with the onset of COVID, when everything was of concern, supply and demand. And it hasn't changed what we're looking for and building the portfolio around in this current period where we have too much demand and it's a supply issue. If we can turn the page, Lou. You've probably seen a waterfall slide like this. We start with an unmanageable, unanalyzable amount of opportunities, roughly 1,000 stocks. We apply a quantitative model that basically is a first cut at that philosophy you saw on the prior page. So we're looking for good businesses. The persistent return model, when we went to the quants, we said, we don't want you to help us pick stocks. we want you to help us identify highly profitable, exceptional business models. And you can see some of the attributes that the model incorporates. Not only is it looking for profitability, but you'll see a high involvement and analysis of the balance sheet. So capital efficiency and profitability is the name of the game as we identify good businesses. As we focus our research efforts on those opportunities, then we select for that offense part. We're looking for compelling investment opportunities. We're looking for market growth, market share growth. And many of our competitors talk about how they're not centered in the moment, that they're arbitraging a longer time horizon. Given how much people fixate on 3 months worth of EPS estimates, I would challenge that assertion. When we forecast out in our fundamental research, we're actually going out 10 years. Clearly, we're not going to be precise over a long time frame. But hopefully we can identify the drivers of exceptionalism and test different scenarios that we're comfortable with, and then match that against what the market is seeing implicit in the valuation. Our fundamental analysis is iterative. When we get comfortable with the business, it's only at the very end of that process that we evaluate the risk reward inherent in the stock. Sometimes we love the business, we don't like the stock, and we put that stock in the proverbial bullpen, waiting for a better entry price. So fast forward to 2021, while it should have been volatile, the market was surprisingly up and to the right. We had qualified more companies than we bought stocks. Fast forward to this year, volatility is obviously spiking, which gives us great opportunity. So just to put numbers on it, last year was our lowest turnover, both in name count and dollar amount. It was less than 20% on both counts. Fast forward to this year, 6 weeks, 7 weeks into the year, and we're annualizing turnover closer to 50%, responding to the dislocations in valuations and seizing on better risk reward skews, for those qualified businesses. So part of our resiliency is being risk on when the world is risk off in order to optimize the portfolio. If you turn the page, Lou. So getting back to that philosophy, that intersection of profitability and investment opportunity, you can see our starting point clearly outlined here. We are that black dot, and the colors are our competitors on a quartile basis. So this snapshot, and consistent with past snapshots, shows that our return on assets, a measure of profitability, is high. Typically, we plot in the upper quartile and sometimes even above the observation for competitors. By the way, the center line is the Russell 1000 growth. The S&P would be a little less growthy on most of these measures, so it would be even below that. So probably kind of more closer to median in some of these observations. So profitability starting point, we're upper quartile. We're looking for investment opportunity, which speaks to secular growth as opposed to cyclical. We're not looking for episodic success, periodic tailwinds. We're looking for that investment opportunity, market growth, market share. And you can see that being expressed on the factor basis with a high plot on earnings growth and earnings growth stability. The final point I'll make on this page is that the advantage of starting with proven profitability is that it gives managements more flexibility to execute on their opportunities. So what do I mean by that? A typical company in our portfolio will enjoy an 18% ROA, return on assets. Let's say it's growing, investing at a healthy clip. Let's say it's growing assets at 8%. The beauty of earning over your asset growth rate is your self-funding. So in this case, 18 minus 8, you have 10% excess capital to return to shareholders. Contrast that to very needy companies on the investment horizon that don't have proven profitability yet. Think of an Uber as an example. They constantly have to go to the debt market. They have to constantly go to the equity market, talk to spin the dream narrative in order to get funded. So these companies are in an enviable situation where they're not beholden to equity and debt markets, which when times get choppy, as they are right now in a rising interest rate environment, they don't have to worry about funding issues. And that's important if you turn the page 4. Ultimately, we want to outperform, but we want to do it in a superior risk-adjusted way. So the prior page showed a quality footprint. And again, a lot of that is built off the foundation of that philosophy. But we also pay particular attention through portfolio construction to other measures of risk. So as an example, we don't want any individual position to be outsized. We want a batting average of stock picking, not demanding slugging. And you can see on risk-adjusted measures how well the portfolio has performed. And you can see with particular outperformance in down capture. Said differently, that quality footprint shines when investors are in a risk-off mode. And as I alluded to earlier, while others are de-risking because they're over the tips of their skis, we can re-risk at better terms of trade. The one measure on this page that has slipped over the last couple of years is that up capture. And that's a conscious decision on our part not to chase outperformance, not to chase, particularly within technology, not to chase higher and higher valuations that came about with lower and lower, ultimately, arguably unsustainable low interest rates. So we're looking for that up capture to improve as we re-risk in a world where others are de-risking. If we turn the page, I thought it would be helpful maybe to generate some questions about where we are in the environment. So this is just part of our standard Q4 servicing. Upper left, I think, is the biggest risk facing growth managers today. Here we show the Russell 1000 concentration in the top 10 names. Even if we looked at the S&P, as many of you probably know, the top 5 names are flirting with the 25% threshold. I point to 25 in the top 5 names as being important because we do believe in diversification for this fund. It's part of our risk measured approach. And we comply with that 40 Act definition. In other words, we don't exceed 25% in our top 5 holdings. Again, that batting average is important to us, not just the mutual fund definition of diversified. The next 2 exhibits point to what was working, particularly in the depths of COVID during 2020, when people were paying anything and everything for secular dream narrative type demand and not worried about profitability, just given where interest rates were. So we show the Goldman Sachs Unprofitable Tech Index. Many of you may notice that this, if you want to look at this index in real time, it has a 0.95 correlation with the popular ARK ETF. If we drew this line to current day, it would continue that downslope. Many areas of technology remain hooked on low rates. Again, not to pick on Uber, I think Uber has burned up over 30 billion plus of capital and not generated a GAAP profit. So there are plenty of names that are quote unquote growth that don't fulfill our definition of intersecting profitability and investment. And then the final one I'll point to here is the lower right. It might take 10 seconds to orient you to what we're showing here. But once you realize what this chart is, hopefully it causes a surprise. Speculation last year started the year off in great form. We had GameStop, we had AMC in kind of the meme stock phenomenon. We had SPACs raising hundreds of millions of dollars on a daily basis, certainly in Q1. It was absolutely aggressive growth, speculative in nature. As we moved through the year, the market became more demanding, but the speculative excess, call it stimulus checks and a lot of free time and not a lot of gaming going on. So the activity persisted in that. If you look at the call option market last year, it exceeded the actual dollars traded. So call options were very popular, and for the first time in history, they exceeded shares turning over. So what this chart actually looks at are some of like the remaining speculative names coming out of 2021. In the case of AMD, you can see on the horizontal axis, 4.5% of its shares turn over on a daily basis, clearly a day trading type beneficiary. But that's nothing compared to Tesla, where the speculative activity on a daily basis, I want to emphasize daily, with weekly expirations, is in the call options. And here you see close to 15% of the volume of Tesla traded hands on a daily basis through those call options. So in that YOLO, you only live once mindset, when you have a near-term call option expiring in days, you're either going to make 100 or 200%, or you're going to leave it all on the table. Obviously, rolling into this year, there's probably 100% loss more frequently than last year. It's a long-winded way of saying we started last year with speculative excess, and as the Fed looks to withdraw liquidity, speculative excess is in retreat. Again, that lack of liquidity, flip side of that is greater volatility, affords us opportunities to engage companies where we didn't like the stock price. Stock price is coming into a territory that we do like, so we can increase our name count. Last year, we ended the year around 50 names. We would love to have a portfolio optimized closer to 55, 60 names. Final page. We talk about the portfolio, again, applying a stringent philosophy and rigorous research. We talk about it as being our best operating plan, so that we don't have to change our exposures based on the environment. And that operating plan is built stock by stock, company model by company model. And I think Costco is an easy example to point to how we never envisioned this environment, but its operating model is performing extremely well. There are two challenges facing retailers and other industries, one being supply chain constraints and rising prices, the other being employees in the Great Resignation quitting. So on the left, we talk about the efficiency in the normal operating plan for Costco, low SKU count, 3,700, versus other big box retailers close to 100,000. So a lot easier to stay in stock. By definition, they have low gross margins. They achieve high return on invested capital by turning their working capital very fast. And you can see every item at Costco is sold on a monthly basis, so turning over 12 times a year. By way of nice factoid to take away from today's talk, no single item at Costco will be marked up beyond a 14% merchandise margin. So again, very, very razor thin margins. We all see the value. We all hopefully sign up for the club. The retention on the club side is phenomenal. Over 90% sign up year in, year out. And obviously their comps show that people still see the value even coming out of COVID. The fast turn on the merchandise side is actually facilitated by a low turn on their employee side, which contrasts to the typical situation in retail industry, but particularly distinct today. I'll just call out over a third of their employees have worked at Costco for over 10 years in an industry in which turnover usually exceeds, in many cases, 100% for some companies. This allows them to maintain productivity in a period in which other retailers are struggling to replace workers who have quit. Just the one thought I'll leave with then is when you think about how this portfolio and this philosophy should perform through the cycle, again, it's designed with risk considerations in mind. So we will typically underperform in risk-on early cycle environments. So think back to what I said about these companies being largely self-funding. When investors early in an economic cycle are looking for literal and figurative leverage, when bad companies are great stocks as a result, this quality footprint will underperform. The good news about underperforming in that environment is it's a great absolute return environment. So it's not challenging the end holders' feelings about whether they're making money or losing money. In other words, I'd much rather lose 200 basis points when I'm making 22% as opposed to losing 600 basis points when I'm losing 20%. So I think it's important to mention that because any manager that says they're going to outperform in every phase is basically saying they don't really truly have a philosophy. When you try to fit to every environment, you often find that you are constantly chasing and getting whipsawed and ultimately producing mediocre or worse than mediocre performance. I think I saw a question about Meta, Facebook. So the fund has held Meta for many years. We didn't purchase it on the IPO. We purchased it several years later. Again, at a controversial point in its life cycle, as it was initially transitioning from desktop, if we can all remember that far back, to mobile. We have owned the stock throughout that period, again, consistent with persistency and the profit generation. Fast forward into last year, our fundamental conviction was being tested on two fronts. And again, it goes back to that philosophy. Front number one was what grabbed the headlines, the dispute with Apple, and Facebook's ability to navigate those changes and continue to target and offer compelling advertising returns to their customers. But even more so, as they stepped up investing in the metaverse, I said earlier on, we try to forecast out roughly 10 years. The problem with the metaverse is, even in that long span, I can't tell you what the return on the investment is going to be. Even Facebook doesn't know that yet because it's so exploratory and nascent at this stage. And yet, as we now know, based on their last report, they quantify the investment exceeding $10 billion per year. So we want consistency and clarity in our investing, i.e., we want superior returns on assets today, and we want to pencil out at a minimum stable returns or ideally higher returns. So we started last year, 2021, probably with Facebook in the top 5 active exposures. I believe we ended last year with Facebook at number 16. So the surprise guidance from Facebook, it was a surprise. It did affect us. It is in our year-to-date performance. but we had already responded to our lessened conviction. So I think that's as far as I can update our stance on Meta. It's astounding. If you look across all their different properties, they touch 3 billion people globally. So it's amazing to see a stock that's essentially such a huge oil tanker experience so much volatility as it did on the day after they reported, when it was down 26%, and it wiped off over $250 billion of market cap. Again, pointing to this market being far more volatile, very different from the last several years, arguably the last 10 years. And typically people ask, why don't we own Facebook? Why don't we own Apple? Why don't we own Tesla? Goes back to that definition. Apple has great profitability, doesn't have a compelling reinvestment opportunity, unlike a Microsoft with cloud investments. Tesla has incredible investment needs, but it's not self-funding. In fact, I would argue it doesn't have a proven profit track record. So it's not neither stock is at that intersection of profitability and reinvestment. The hit from not owning those was substantial, and I think that should give you confidence that we adhere to our philosophy. We don't bend to benchmark. We don't bend to perceived business needs. So we've absorbed that hit in 2020 and 2021. On a combined basis, Apple and Tesla added $2.5 trillion worth of market cap. So that was quite a headwind. And, arguably, I think I'm on sound ground saying in the next 2 years, it's highly unlikely that they're going to add on another $2.5 trillion. When Apple touched 3 trillion, it eclipsed Germany as the largest, if it were standalone, as the largest equity market. So law of big numbers is definitely going to be playing a role in their incredible ascent. Great.
Excellent. Thank you, Leah, for your time today. As I mentioned in the beginning, my team will be reaching out to throughout the RPAG network to answer any questions you may have and to see what we can do to help you grow your business. But as I mentioned, we look forward to marketing this solution within your system. And Leah, thanks again for your time.